So several years ago, I was listening to one of my favorite financial podcasts, and that day they happened to be talking about how you could reduce required minimum distributions using qualified charitable distributions. Now, I'd never heard of qualified charitable distributions or QCDs, but I had parents and in-laws who were reaching RMD age, and I also knew they were givers, so I listened in for more. And as I listened, I learned how QCDs can reduce or eliminate RMDs altogether. Now, in case you're wondering, not everybody needs the required minimum distributions that the IRS forces them to take. As a result, it creates a tax liability they'd rather not have. In fact, according to Ameriprise Financial, 68% of people who take RMDs only take the minimum required amount, not a penny more. I don't know how many of those people actually need the RMD money they pull out, but it seems to indicate that at least a large portion probably don't need the money at all. Now, in my family situation, I knew my parents and my in-laws were charitably inclined, that they gave regularly, so I told them about QCDs. As it turns out, it's a very useful tool to them in tax planning. In this video, we'll talk more about qualified charitable distributions and how you can use them to your advantage. So as we kind of touched on from the outset, qualified charitable distributions are a way to reduce your required minimum distributions from tax-deferred accounts once you reach RMD age. When you turn either 73 or 75, the IRS will begin forcing you to remove money from tax-deferred accounts so they can collect income tax on those balances. As we've also already pointed out, in many cases, the retirees don't need that money. RMDs simply create a tax liability they'd rather not have. Now, RMDs are calculated using a formula the IRS provides, and the amount of RMDs as a percentage of the portfolio's value increases as you age. If you fail to take an RMD, you'll owe a 25% penalty on the amount that you were supposed to remove for each and every year you failed to take the money out of the account. Now, qualified charitable distributions give you a dollar-for-dollar credit against your RMD for any amounts that you donate directly to charity from the account. Now, since QCDs are taken out of a tax-deferred account, you don't get a tax deduction for the donation, but you've also never had to pay any tax on the amount. Now, you may be thinking to yourself, Curt, couldn't I just take the RMD, then write a check to the charity and take a tax deduction for that? Yes, you could, but because you took the RMD, your modified adjusted gross income would be higher as a result. Now, higher modified adjusted gross income could put you in a higher tax bracket. It could impact your ability to make conversions. It could have an impact on how your Social Security is taxed. It could also increase your Medicare surtax. Let's look at an example to show you how qualified charitable distributions could be mathematically advantageous. Let's assume Fiona Philanthroper is 73. She's reached RMD age and has to begin taking those this year. Now, Fiona's also begun collecting Social Security, and she has a pension from her employer. Both of these together cover all of her living expenses each and every year. As a result, Fiona does not need to withdraw any money from her IRA to live on. However, RMDs are going to force her to take income out of that account and pay tax on the amount that she withdraws. Now, the good news for Fiona is she learned about qualified charitable distributions. She now realizes instead of making an RMD, she can redirect that distribution directly to her favorite charity, and her taxable income won't increase as a result. In the end, the donation that she would have made out of her checking account will stay there. The charity still gets the money that she would have donated, and now her income tax bracket will stay super low. Okay, there's a few important things to note about qualified charitable distributions. The first is your qualified charitable distribution must go directly from your IRA custodian to the charity. You can't touch it at all. If it ever comes to you, it counts as a distribution, and your qualified charitable distribution is blown up. In 2023, you're limited to a $100,000 qualified charitable distribution. You can also begin making qualified charitable distributions at age 70 and a half, even if your RMD age is 73 or 75, depending on when you were born. Your RMD amount is used calculating your tax-deferred account balance on December 31st. You'll take that number and divide it by another number that's given on the Uniform Lifetime Table on the IRS website. The product is the amount you must take as an RMD before December 31st of the following year. For your QCD to count toward your RMDs in a given year, they must be distributed to the charity by December 31st of that same year. You cannot make a QCD from a 401k, but you can roll a 401k to an IRA and then make the QCD from there. Finally, you don't have to make your entire RMD as a qualified charitable distribution. You can do it in any portion, but the remainder of your RMD must be withdrawn by the end of the year. So there you go. QCDs are a super handy tax planning tool in retirement. I hope you found this helpful. We have plenty more on our channel and website about IRAs, 401ks, tax planning tools, anything related to personal finance. That's at martinmoney.com or on our channel here. We'll link some other playlists, videos, and things like that in the description below. As always, we're so grateful for your interest in our video. Thank you for your time. God bless and take care.